What up, everybody? It's Matthew Mickey here, and the market has surely been hard in the year 2022. Thankfully, my portfolio is up for the year, but for us degenerate grunts, like the Fed let us down, inflation got on a power trip and stole the spotlight, and now we have the lingering nightmare of a recession trying to get attention, right? Who can we trust in these markets? Santa Claus. Santa Claus, Santa Claus, Santa Claus. That's right. All I see on my feed is seasonality this and Santa rally that. And yes, I think there will be a rally, but I think that rally will be rewarded to the good little boys and girls who acted right all year long in the energy markets, right? So let's talk about that. Before we get into it, let me give a huge shout out to Darius Stowe from 42 Macro, the Maverick of Wall Street, my really close friend Saad, and last but not least, Joe Schmuckatella. He's a Canadian coal trader, and him and his boys know everything and anything there is to know about this market, which is really good to know. So we know that if we look at historical patterns, 30 years, 15 years, 5 years, highlighted in yellow on the screen, you can see that, the first 2 weeks in December, crude oil usually drops lower and fixes any kind of imbalance or inefficiency out there. And then it spends the second half of December going all the way into April, March, February timeframe rallying, right? And that's due to demand increase from wintertime oil, right? We can also see in the last 3 years that the crude oil market has ranged 11% positive to 18% positive in the month of December, and we're already down negative 15% for the month. So we know that all year long we've been in a bear market, and within that bear market there's been a negative correlation between the S&P 500 and crude oil. So if we look at the way the commercials are set up, right? I pulled this data from COT base. We can see that like the commercials in the last 6 months, they're above the high and the low. The midline would be 3,331, blah blah blah. But either way, we can tell that they're hedging for downside movement. So like as we go forward, we want to keep an eye out on if they start pulling off those hedges. That will lead to them being positioned net short, and that will allow crude oil to go to the upside. So basically what I'm saying is if crude oil has a Santa rally, the S&P 500 probably won't, and vice versa, right? But now let's talk about the headwinds and the tailwinds between China, Russia, Saudi Arabia, and America. Okay, starting with China, we know that China started opening up 3 of the most populated cities this week, and that could act as a tailwind for crude oil. The Aussie dollar weakens the dollar due to the increased traffic, possible growth in their economy, and a strong winter demand in crude oil. We also saw that China boosted the gold reserves for the first time in over 3 years, and a possible attempt to diversify away from the dollar, right? I mean, we can see a lot of countries are shifting from the dollar and looking for, like Saudi Arabia, looking for a way to reduce some of their risk in the dollar, right? Saudi wants to shift to the BRIC. Brazil and Indonesia are trying to find a new currency to trade commodities. India already said that they would buy Russia oil. This is all weakened catalyst for the dollar. And then we can talk about the strength in the European GDP right now, but that's not what this video is about. So we saw this week that China and Saudi met, just discussed China developing their own commodity-based exchange. Like Xi Jinping established a Juan Pedro transaction during this meeting, which allows oil from the GCC using the yuan and not the US dollar, right? With promises of increased volume and increased stability, like from the GCC to China. I think this will be event that plays out throughout years. However, like we can see that Saudi's Aramco is also committed to increasing their capacity from 12 million to 13 million barrels a day in the year 23, and they always meet the requirement. And like so, this sets up for them to heavily invest in their capex, right? Whereas U.S. oil majors are decreasing their capacities, and that's due to the U.S. government putting too much pressure on refineries, making it impossible for them to invest or increase in their capex, because every time they do, Biden raises the taxes and puts red tape on their free cash flow yields. And so why would U.S. oil majors invest in increasing productivity, right, when they keep getting slapped with ESG regulation and taxes every time they try to? The current government just takes all their profits. Now we can see that the meeting between Biden and Saudi Arabia a couple weeks ago didn't go as good as the current meeting between China and Saudi Arabia, right? And we have noticed in this quarter alone that, you know, the monthly shipment to the U.S. from Saudi Arabia has fallen the lowest since January 2017. What is that telling you? That's telling you that Saudi Arabia is not playing with this current U.S. government. They can find business elsewhere, right? And then if we look at the following chart, it shows us the U.S. fracking crews are flattening out, and the jobless rate in oil and gas industry is at the lowest since 2005, right? And this is for the U.S., right? And this falls back into the government's not supporting them, so why would they try to work hard, right? So let's see why we're seeing a flattened out, you know, fracking and all that. Now we're going to transition to America and the Russia game. So we can see that Saudi crude shipments to the U.S. is the lowest it's been since 2017. This could be a leading indicator that there could be another OPEC cut, right? We know that the U.S. domestic exports at an all-time high. So stop blaming inflation on the lack of supply in the oil company, right? We told Europe and Asia to stop buying oil from Russia. Now they are all short of oil. And like, for example, Euro is projected to run out of natural gas in the year 2023 if the Friedman facility doesn't open up. So who's going to, if we're flattening our production, right? Who's going to provide the oil? Right? So let's talk about what's happening in Russia. So there's a couple of headwinds or tailwinds that we can look at. I'm going to look at this in two scenarios, right? How is Russia going to respond to the embargo and the price caps, right? So last week we put a price cap on Russia oil at $60, even though Russia oil is trading like $20 less than that. So Russia's annoyed by this, right? As Russia continues to be sanctioned, like they don't want a price cap, but still will be able to sell oil at a discounted price, right? This will allow Euro to spend more, but make it through 2023 with the right amount of oil, right? This allows us to work on a peace deal between the U.S. and Russia, and then hopefully the Freeport facility will open, right? And this would be a headwind on crude oil, right? Now the tailwinds, which we can see, right? OPEC's forced to cut, Russia oil tumbles, right? All the pipelines between Russia and Euro are shut off. The U.S. continues to be forced to export domestic oil to Europe and Russia, right? And we already saw that, like, production is flattening out, and we're going to hit a cap on what we have in our reserves soon. And then Euro runs out of national gas in 23, right? You know, like this already. So we need to pay close attention on how this week Russia like responds to all of this, right? So far we've talked about a lot, right? So back to the seasonality, right? Like I think even though the market seems like it's in a transition and that we're confused and everybody thinks we're going into recession play, like there's still too much tailwinds in the energy market for this just to come to an end, and energy usually leads the recession downwards, you know, but like I don't see that happening anytime soon, right? So that's what I'm looking for. Now let's talk, or if I forgot something, but like when I'm looking at economic catalysts within the oil energy department, whatever, right? I'm going to be focusing on OPEC. Are they cutting? I'm going to be focusing on the, you know, refineries and the production and the capacities of the 8, I think it's 8 or 12, it's 8, between 8 and 12, you know, energy producers, right, from a global standpoint, right? And then I'm going to pay attention to the supply and demand features. Now, going into the individual companies, it's a different way of looking at it, right? In the next video, I'm going to come up with, you know, like I'm going to be teaching how to look at how to identify the outliers within the industry. I'm going to be talking about how to find the KPIs and the catalysts within that industry, and we're going to figure out what the best play for this is going to be from equity standpoint. All right, guys. Hopefully this helped. Later.